Let's look at the disclaimer. This content is for educational, informational, entertainment purposes only, and nothing should be taken as a recommendation to buy, sell, or hold any securities at any time. We're here just to tell you how BTA look at the market, how we analyze the markets. This is Rod from BTA, and we are known as the Middle Traders. What we're going to discuss in this video is the fact that we're hearing a lot of talk all over the internet, all over the TV, all over the news, all in the newspapers about recession. I'm telling you, and I'm going to prove it to you right now. Not from what I'm saying, but from the data, from the historical data, that the recession is not here yet. We are not in a recession, and it doesn't look like we're going in it right now. It's coming, but I'm going to show you how to see when it's there, when it's near, when it's right on top of you, when it's on its way. Yeah, we got a recession coming. There's no doubt about that. I truly believe that also, but it's not here yet. Like my son say, Daddy, are we there yet? No, we're not there yet. And let me prove it to you. We're going to start off with this first snapshot here. I got a screenshot, rather, I'm sorry, of something I showed y'all once before. Okay, it's the inverted yield curve. It's a spreadsheet showing when we got the inverted yield curves. We got when the stock market peaked, unemployment, and then a recession. Okay, I showed y'all this once before, but I just want to bring this back to y'all attention once again. Okay, because I want y'all to keep this in y'all minds. This is why I keep saying to y'all, I think we're going to go back and rally. We're going to get a relief rally in the midst of this bear market. We're going to get a relief rally. It's going to run back up to the highs of the inverted yield curve date, or maybe higher. Test the 200-day moving average, which is way up there right now. And then we're going to see unemployment numbers rise, and then a recession hit. That's how it's going to happen. It has happened every single time in the past. Every single time. And I think it's going to happen again. Okay, look, because I'm betting on the side of history. So back in 1978, we had the inverted yield curve. This is the dates of the inverted yield curve. Now, we're going to go through this real quick. 1978, we had the inverted yield curve. Okay, we had the inverted yield curve. Then 18 months later, the stock market peaked. So 18 months after the inverted yield curve, the stock market peaked. Okay, 10 months after that inverted yield curve, we had unemployment numbers started to go up. We had job losses. And then look what happened. 18 months after the inverted yield curve, we had the recession. So we get the inverted yield curve. Okay, we get job losses, and then we get the recession. So now this is the one time that the peak in the market, we peaked. We ran up to the peak. After the inverted yield curve, the index went higher. This is one time where the index went higher, and we had the recession right around the same time, 18 months after that. 18 months after the inverted yield curve day. But look what happened before the recession. You see you got job losses? That's the key. That's the key. Now, let's back up. Let's back up for 1 minute. For everybody who may have not been in the weekly meetings that we have, okay, let's talk about what the inverted yield curve is. Well, the inverted yield curve is basically when this is a chart here of the 10-year Treasury yield and the 2-year Treasury yield. The yield is the rate of interest that is received, the interest rate that is received, the rate, the interest, the return. That's the yield. Okay, so I'm going to bring up another chart here. Okay, I'm going to bring up another chart here so I can make it a lot easier, okay, for you all to see it and understand it. So here is a chart of the yields for the 2-year yield, right? The interest on the 2-year security. You see here is 3.17. The 10-year is 3.25. So you got to figure, if you lend the government money, right? If you lend the government money and you lend it and you lend the government money for 2 years, you're going to get a certain amount of interest back. But if you lend the government money for 10 years, wouldn't you want a little bit more interest because you let them have the money for a longer period of time? So the 10-year yield, the return that you receive, okay, for purchasing those treasury notes, bonds, or whatever you're purchasing, you want that yield, if you buy the 10-year one, to be a little higher than the 2-year one, because you lent the money for a longer period of time to the government. So quite naturally, you want to make a little more interest on your money. That's a normal curve, okay? But when the curve is inverted, when the yield curve is inverted, what they're telling you is that that's at a point when the 2-year yield is higher than the 10-year. So where the 10 years is 2.25 right now, the 2-year yield may be, 3.25. The 2-year yield may be 3.35 or 3.30. Okay, that's inversion. That's what you call inversion, when the shorter term treasury is yielding more interest than the longer term treasury. It's upside down. That's when you got what they call an inversion. It's upside down. It's an inverted yield curve. Okay, so this chart you can see here. All right, this is the zero line. This is the zero line. This horizontal blue line is the zero line. Anytime the 2-year yield is higher than the 10-year, it gets below zero. You see, that's when it's inverted. When it's below zero, that's telling you that the 2-year yield has now moved above, higher than the 10-year yield. It's inverted. After you get inverted yield curve, that's a sign of a possible recession coming. Okay, that's the sign of a possible recession coming within about 18 months, 12 to 18 months, something like that. Okay, there's no exact science. Could be a little longer, but it's coming. So now let's go back to this chart real fast. Okay, so here we get the inverted yield curve. This is dates. We get the inverted yield curve, right? When the 2-year moves above, higher yield than the 10-year. 18 months after that, when we got that inverted yield curve, 18 months after that, the stock market was higher. It peaked. It went higher. Then you start seeing job losses, and then you get the recession. So the job loss is going to come before the recession. Look in September 1980. Are you picking up what I'm dropping down here? Are you picking up the jewels that I'm dropping? Do you hear me? Look, in September 1980, we had the inverted yield curve. The 2-year yield went higher than the 10-year. 2 months after that, we peaked. The stock market went higher than the high of that inverted yield curve date. 3 months after that, we had unemployment numbers increase, job losses, unfortunately. 10 months later, the recession started. You see the job losses come before the recession? You see that? Almost every time, job losses come before the recession. Look at January 1989. 18 months later. Look, 18 months. It took 18 months for the stock market to get higher than where it was in January 1989. In July 1990, the stock market was higher than it was in 89. It peaked. It peaked. So that means it ran down, maybe consolidated, but then it rallied. You see why I keep saying we're going to get a rally? You see why I'm looking for the rally back to the highs or higher than the inverted yield curve date? You see what I'm saying? You following me? Can you feel me? In 89, we had the yield curve inversion. In 1990, 18 months later, we peaked. The stock market went higher than the high of the date of the inverted yield curve, higher than that high. 3 months after the inverted yield curve, 3 months after the inverted yield curve, we had job losses. So we started getting job losses and the market still ran up in 89. Just like in 1978, we started getting job losses first, but the market still ran up. But at the end of the day, before the recession hit, almost every time you're going to see job losses first. We get an inverted yield curve, then we're going to peak. Job losses, then recession. In January 2006, 21 months later, we peaked. We started seeing job losses 14 months after the inverted yield curve date. But look, we started seeing job losses before the recession started. Job losses, y'all. What's the common thing right here? We get an inverted yield curve. The stock market rallies to higher than the high of the inverted yield curve date, or at least as high as the high of the inverted yield curve date. That's common amongst all of this. The next common thing is that we get job losses before the recession. I told you I'm going to prove it to you. I ain't finished yet. Okay, I'm going to prove this to you before it's over. Okay, let's look at another chart. Let's look at another chart real quick. 2 year and the 10 year right here. Notice something. Notice something. This is the chart of the inverted yield curve date. This is the zero line right here. This blue line is the zero line. That's when you cross below that, that's like I told you, that's when the 2 year yield is higher than the 10 year. Notice something here. When we cross below this line here and we got inverted right here, you see how the market went a little higher? You see how we got inverted again right here? You see how the market ran up a little higher? Look, we got inverted right here. This is a 20-year chart, by the way, y'all. Notice this is going back over 20 years. Okay? I'm looking at all the inverted yield curve dates we had in the last 20 years. Look, back here in 2019, going to 2020, we inverted. The 2 year got higher than the 10 year. You see how this market ran up? This is a chart of the Standard & Poor's 500. We're using this as a gauge of the overall market. When you had the inverted yield curve, before the collapse, before the recession, the market went higher. Now we got an inverted yield curve now. Recently, just in 2020, we had one. Okay? We had an inverted yield curve already. All right? That's why I'm telling you the first steps has been completed. We got the inverted yield curve. Right? Let's get the inspect tool here so we can see what date that was around. That was back in around March 2022. We had an inverted yield curve right here. Okay? Can you see that? Follow me here now, y'all. We had an inverted yield curve right here. You see the market traded down after the inverted yield curve? We traded down. I'm telling you, that's why I'm telling you. But that has not happened. Every time in history, we ran back up to the highs. We peaked. In other words, we peaked. We went higher and peaked out after the inverted yield curve date. I'm looking for it, okay? I'm still telling y'all that I've been saying it. I'm looking for the market to rally, to bottom and rally, run back up. Let us make that ching ching on the way back up. Okay? And then we hit them again on the way back down. Because when those job losses start to come, we know that the recession is on its way and the market will sell off in the midst of that recession. Okay, now let's look at something I didn't show y'all before. This is the 2-year yield, the 10-year treasury yield versus the 3-month treasury yield. The 10-year versus the 3-month treasury yield. Okay? And when that get inverted, also, it is a warning sign that the recession is on its way. Okay? And when that get inverted, it's going to be even sooner that the recession may come. Right now, we are a long way before the zero line. Okay? So the 10-year is still well above, still yielding much higher than the 3-month. It's at 1.62, the inversion. Okay? Okay? So we are not inverted right now. We're not below the zero line here. So the market is selling off, but look how far we're away from the 2-year, the 10-year and the 3-month inversion. We're a long way from it. Okay? It's not here yet. So I know the fear that they're trying to stew up in the market right now. I understand that. I know. But that's exactly what they're trying to do, stir up fear amongst us. All right? Because they can get you fearful, they can start getting you to make bad decisions while they make money when this thing rally. You scared to death. Can't pull the trigger. Scared to death while they buying the bottoms and running it back up to the top on you. And then when they start saying, oh, the market is at new highs, all over again, the economy is booming, you say, oh, I got to get back in. And that's when they pull the rug out from under you. Recession hit, bang, it's all over. Pop, stock market drops. Don't get caught in that. Okay? Look, this is another little screenshot of the inverted yield curve, the 2 over the 10s. Okay, I just showed you a more up-to-date, real-time version of that. So we don't have to look at that. Let's look at one more thing. Those unemployment numbers. You see this chart? I showed it to you before. Look, I got the red line right here. This is the Ichimoku cloud, okay? With just the cloud and not the moving averages that you see when we look at our trading platform, okay? So this blue line is the unemployment numbers. You see unemployment is going down, right? Unemployment is going down here. But when that unemployment rate crosses above the cloud, this downward red cloud, when it crosses above the cloud flips to green and start going up. This blue line start going up. That's telling you that the unemployment numbers are increasing. When that starts to happen, y'all, when that starts to happen, look what happened in the stock market. It sells off. Down here is a chart of the Standard & Poor's 500. Look what happens. Look again here, y'all. The unemployment numbers start coming down. The cloud turns to red. The unemployment numbers, the blue line here represents the unemployment rate. It starts coming down. Look at the market rallying. But look what happens when the unemployment rate crosses above the cloud and the cloud flips. Look, the market sells off. Where are we at right now? We're well below the cloud. When this number starts turning and we get above this cloud and this cloud flips, trust me, that's when the big one going to happen. That's when the big one going to happen, because that's telling us the recession is on the way. What did I just show you earlier in that little spreadsheet? Job losses, then recession. Stock market tops, then it pops. Point blank and period. Be careful. Let me show you something else that's very interesting, okay? Let me prove to you, okay, something else, all right, that's very interesting. Read this in an article. I had to take a snapshot of it, okay, and show it to you. And it was very interesting, okay? Look at this, right? This is the Philly Fed, all right? Well, I go to their website, too. I'm not sure if I read this in an article. I saw it on the Philly Fed website. All right, the Philadelphia Fed, Philadelphia Federal Reserve, whatever you want to call it, don't matter to me. This is a chart showing you, okay, the number of states that is increasing their economic activity. If you got a problem with your finances, are you going to run out there and start increasing your economic activity, start spending more, building more, doing more? No, you're not. You're not. And that's the same thing with the different states. They trying to run their budget just like you run yours in your household. Look, when this red line, which represents, okay, the economic activity, number of states showing economic activity. Look, it's 50 up here, 0 down here. Do you see when it's all the way at the top, this blue shaded area represents a recession. This blue shaded area represents when we in a recession. You see it just turned blue for just a little while over here for the corona collapse in March 2020, the corona collapse. So when this blue shaded area, we see the blue shaded areas here, it's recession. See it says the blue stands for recession. The red, states increasing their economic activity. The red line shows you the number of states that is increasing their economic activity. Look, when it's very high, do you see anything blue here? No recession. When it's very high, it's no recession. Don't you see when it get way down here with only 10, 15, 5 or 10, 15 states, those are only 5 or 10 states in the entire country that's increasing their economic activity, doing more economic things for the state? When you get down there where it's only 5 or 10 or 15 of them, look what happens. You're in a recession, y'all. You're in a recession. Okay? You're in a recession. When the number of states that's increasing their economic activity starts to come down, and instead of 50 states and maybe 40 states, then 30 states, then 25 states, 20 states, when you start seeing the number of states, less and less states increasing their economic activity, then you're going to run into a recession. Not when it's all the way up here, when almost everybody is doing everything, spending all kinds of money. That's not when you get a recession. You get a recession when they're cutting back economic activity. Look, forget about what they're saying in the news. Forget about what they're talking about in the news. I'm telling you, follow the data, and you will know when the recession is on its way. Are you picking up the jewels that I'm dropping? This is not financial advice, but wouldn't it be wonderful if it was? Wouldn't it be great if it was? But it's not. But if it was, ching, cha-ching, ching, ching. Okay? Look, right now, we are at the highest levels. Almost every state in the country is increasing its economic activity. The recession is not here yet. When it start coming down and less states is increasing its economic activity, when only 10, 15, 20 states, 5 states, when that thing start coming down, when we've tracked the Philly Fed and that economic activity start coming down, we know the recession is almost there. Okay? On to the next one. I'm going to show you something else. All right? I'm going to show you something else. We got that from the Philly Fed, right? I'm going to show you something that I pulled down off of Guru Focus, where I get some of my data from. Because I don't look for advice. I look for data. We are analysts. Okay? Look, this is Guru Focus. The gray area is when the recessions. This is what I pulled up off of Guru Focus. I'm looking for when the insiders are buying. The insiders versus the buys versus sells ratio. When the number of insiders, who's the insiders? The CEOs, the CFOs, the chairmen of the boards. Those are the insiders of the corporation. When they're buying, you got to figure the stock is cheap. That's why they're buying. So you want to know when the insiders are buying and when they're not. They love to buy when you're in the midst of a recession because you're getting stuff dirt cheap, 50 cents on a dollar or less. It's blood all over the streets. They go shopping. Okay, Look at this chart. All right. You see the gray shaded area? That's when the recession is on. You see, they buy the most when it's in a recession because everything is on sale. That's when they start buying. See the gray shaded area here? Look how the number, the buys, way more buys than sells. This the buy inside the buys versus the sells ratio. When they buying more, this blue line goes up. Way more buys than sells. You see where it's at right now? It ain't cheap enough for them. It ain't sell off enough yet. So you think it's a collapse, but it ain't collapsed quite enough for the insiders to start buying yet. When they start buying, you know the stock is dirt cheap. They know the economics of the company. They're not going to buy something that's going to collapse tomorrow and lose money. No, these people trying to make money. And they got all the information from the company in the books. They got the books. They know what the sales and the revenue and debt and everything. They got it all. They can project it in the future. They got it. It's their company. When the stock is dirt cheap and too cheap, they start buying. They normally do that in the midst of a recession or a real hard economic downturn. Recession, they buying. They're not buying all that right now that much. Okay? They're not. The recession is not here yet. Okay. Let's look at some more evidence, some more proof that we're not in a recession. This is the Standard & Poor's momentum chart. Listen, when you got a lot of momentum, it ain't fell off yet and it's not in a recession. The momentum is coming down. Okay, but you see it starting to rally up just a slight bit over here. Look at the most current data. It's trading down because we are selling off. We're in a bear market. We see it's ticking up just a little bit. Did it get below zero yet? Did it get below zero yet? This is an anomaly. This is 2020 Corona collapse. So it fell off, but it rebounded right away. This is a Corona collapse. That was not, that was an unexpected thing that just shocked the whole world. But normally, you're going to see when we start getting down here below zero and staying below zero, we heading into a recession. You see the momentum when it gets below zero? Gray shaded area, momentum gets below zero. Gray shaded area gets below zero, stays below zero. Start getting deep into the negative recession. Are we there yet? No, we're not there yet. You see, we just at 50. We're not down there zero yet. I'm trying to prove it to you. I'm giving you the economic data to prove to you that we are not in a recession yet, and we don't see it right now. It's coming, but it's not here yet. Look, this is a very, very important chart. I'm telling you, this is an important chart. Look at this chart. Okay? The blue line is the Standard & Poor's 500. The yellow line here is the sales per share. They sales per share. That's the yellow line, the sales per share. Notice when the red line, which is the earnings per share with estimates trailing 12 months. Just say it's the earnings per share with the estimates. I want to make it simple. You see, when the earnings per share start coming down, it's right before we get into the gray area, which represents the recession. The stock market's already selling off, granted. But before the recession hit, you're going to see the earnings per share coming down. The green line is the earnings per share. The green line is the earnings per share. Okay? The red line is the earnings per share with estimates. You see the red and the green line coming down, turning down before the recession hit. Look at the red and the green line here. It turns down. This time it almost turned down right when the stock market started collapsing. You see it? The blue line is the Standard & Poor's. That's the market. The red and the green line is the earnings per share. Okay, I don't want to get too technical on you, but you got earnings per share and you got the operating earnings per share with estimates to 12 months. It's earnings, okay? The operating earnings is just a little bit higher than the regular earnings, the bottom line earnings, the net earnings. I don't want to get too technical. Just know. Just know. When you see the operating earnings, which is the red line, that's the earnings number with estimates. If you see the earnings per share number, the green line, the earnings, in the bottom line, just look for the earnings. Please just look for the earnings to come down. When the earnings start coming down, hey, recession is on the way. Look over here. Earnings started coming down, turning down, stock market peaks, we go into recession. Do it look like the earnings is coming down right now? We at all time right now. We're booming. When we start seeing this turning down, all right, look out. The recession is on the way. Okay? Point blank and period. Let's finish this off. Let's finish this off right now with one last chart. Okay? One last chart. Right? This is the operating earnings, the operating margins. They're margins. Okay? How big of a cushion they got before they go pop, before they start losing money. The margins. You see the margins start coming down before the recession hit. Okay, you see the margins going to start coming down before the recession hit. It even did it before the 2020 Corona collapse. You see where we at now? Operating margins at all-time highs. No matter what they say on the news, you've just been shown how to track it for yourself. I know a lot of y'all may not have time to sit around and do this all day right now, but I do it. And I have no problem sharing my data with you because this is what I do every day, all day. Okay? This is not financial advice, but wouldn't it be wonderful if it was? But it's not. But just imagine if it was. We got our eye on everything moving. We don't have to listen to anyone other than the data and the charts. See you in the next video.